Thanks for joining us for Denise Appleby's breakout, where she's going to be discussing critical rules for moving retirement accounts. So I'm going to pass it along to Denise, and we will be running mics. I'm not sure if she'll be taking questions throughout, but we'll be here if she is. So Denise, take it away.
How is everybody doing today? All right, so today we're going to get elementary and we're going to get complex. And I don't like to do speeches, right? You didn't come here for a speech, did you? No. All right. So let's have a conversation, which means as I'm going along, and if you have a question, just stop me and let's talk about it, okay? Because sometimes by the time you get to the end, you forgot what you want to ask. So we're going to be talking about moving retirement assets today, because there's one thing I can guarantee that's going to happen with a retirement account is that it's going to move, right? Even if it's moved by the beneficiary. And there are rules that we need to think about depending on if the account belongs to the owner or the account belongs to the beneficiary. So we're going to be talking about transfers, rollovers, etc. I tried to wear the same suit so you would recognize me. But I couldn't find a yellow blouse. Oh, you want to I'll send you a copy. So at the end of today's session, the hope is that when we have conversations with clients, we recommend the right method for moving the assets. I had a pre-conversation with an advisor earlier, and his question was, my client have a Roth IRA, and he wanted to do one of those things where he wants to buy a home and sell a home. The cash is not available to buy the home now, so he's going to take a distribution, put it back within 60 days. But if you've read my articles, you know what happens when people do that, right? Yeah. 60 days come around, and the first house still hasn't been sold. And in one of the cases, the taxpayer went to the IRS and said, listen, I missed my 60-day deadline. And you know why? Because I wanted to sell a house and buy another one, and the first sale didn't go through. But it's not my fault, because my advisor didn't tell me that the 60-day rule applied. And my real estate agent said I could do it. And the IRS said, you know, I feel bad for you, but I can't help you. Because first of all, you shouldn't be taking advice about your IRA from your real estate agent. And the law says, unless this is a 401k, nobody's responsible for telling you about the 60-day deadline. That's your responsibility. You know, for me, it's like when I take out a life insurance policy. It's the same thing when they open an IRA. But still, we don't want them to be pointing the finger at us, right? You have one of my quick reference guides, and for free. I publish these. If you ever want to buy my stuff and you go to IRApublications.com, just type in, for this month, it's April, and you get a 50% discount. Other than that, you just type in slot and you get 30%. So the primary lessons here is that when we're moving retirement accounts, we want to move them with the objective of, okay, the objective here is that the client's going to be moving the retirement account, and if they're moving it, they want to maintain tax-deferred status, right? I'm going to come down so I can see the slides. And for you guys, yeah, from what I hear from Ed Slott, you do very well with your clients. They make a lot of money. And you know that depending on how clients call you, depending on their mood, that shifts with the stock market, right? Stock market's doing great, maybe they don't even call you. Stock market's doing poorly, and then your phone rings off the hook. But, you know, I like to remind people that, yeah, it's okay to make clients a lot of money, but see all that money that you help your client make? They can lose all of that with one bad transaction. Right now, a taxpayer owes the IRS $8.5 million in penalties. Why? Because he made an ineligible rollover to an IRA. When you make an ineligible rollover to an IRA, it's not excluded from income, right? And that was the intent. And guess what? Because it's not eligible to be rolled over, you got to fix it by doing a return of excess. What happens if you don't? It accrues a, say it again? Penalties, right? 6% excise tax for every year it stays in the account. One person, $8.5 million in just a 6% penalty. Well, you know, he had a lot of money, right? But still, you don't want to be giving the IRS $8.5 million because you didn't hire an elite IRA advisor, right? So retirement assets right now is about $33.6 trillion. 11.5 of that is in IRAs, 22.1 is in employer plans. Why does this matter? Because eventually the assets in employer plans are going to be rolled over to IRAs, which is why I'm focusing on IRAs today, because that's where it's at. Rollovers should be handled with care. If a client comes in to see you and say, I want to move my IRA to you. Usually when an advisor calls me, they'll say, Denise, my client wants to roll over an IRA. I see you mouthing back there, so I know you know that conversation. Denise, my client wants to roll over their IRA to me. And I say, hang on a second. I think you mean transfer, right? And they'll say, yeah, but, you know, I'm right here with you. You know what I mean. And of course I know what you mean, which is why I'm going to stop you. Because here's what happens. If you go to the IRA custodian and you say, I want to roll over my IRA, they're going to say, sign this distribution form, right? So terminology is so important when you're having conversations about IRAs. If you want to do a transfer, you absolutely have to say transfer. And one of the big differences with a rollover and a transfer is that rollovers are reportable, and there are limitations that apply. I'm going to be talking about those. But with a transfer, they're non-reportable and non-taxable. But let's say you work at firm A, and a client comes to you and say, I have an IRA at firm B, and I want to transfer it to you. Anyone knows what you say to that client? You say, go to firm B, right? If you're with firm A and they want to transfer it to you, then you initiate the transfer. So you submit a transfer whether through the ACAT or the non-ACAT system, and there's no tax reporting, and all you complete is the transfer form. These are the clients that you want to have, right? This is what happens when you do transfers right.
They have a good dentist.
They do. Hi, Ed.
I just want to say hello. I was in the other room. Welcome back. There's some makeup for Denise, right?
Yes.
Yeah? All right.
Yeah.
Well, you're going to learn a lot here.
So this is what happens when you have happy clients. And this is what happens when the client is sitting across from you and they're blaming you for everything under the sun with their IRA, even if you didn't do it. So what I recommend is that for every client that you have that have an IRA, you encourage them to come and see you before they initiate any transaction, before they complete any paperwork. 2 cases that I'm working on right now, husband died, didn't name a beneficiary, was a 401k. The plan administrator pushed out the assets to his estate. What's wrong with that picture? He was married. They had stuff on file where she was the beneficiary of his medical policies, insurance policies, and because he didn't complete a beneficiary form, you're telling me you didn't know that he was married? So they pushed out those checks, withheld 20%, and they went to the attorney, and the attorney called the firm. It was Fidelity. Anybody here from Fidelity? I love Fidelity. Okay, but this is what really happened. So they went to Fidelity, and Fidelity said, no, we're not fixing it, because based on our record, the estate is a beneficiary. So the attorney calls me, And I called up Fidelity and I said, do you know who you're talking to? I'm kidding, I didn't say that. But, you know, usually when you call an 800 number, the person that you're speaking with really wants to help you, right? They're not being mean. But if they don't know, you have to educate them. And so in that case, we educated them to the fact that ERISA law says because he was married at the time of death, his spouse had to be the beneficiary, right? And so that meant they had to reverse the distribution that was made to the estate, reverse the tax withholding, and do it the way that it should have been done.
Quick question about that.
Yes,
Did they do it? Was
they did.
the reason that you were able to do that because the spouse didn't sign a form saying, I'm not the beneficiary? Because that's, the only way you cannot be a beneficiary is if you sign a form saying, I'm not the beneficiary, right?
Exactly, if you're married. You know, there, like some plans will say, as long as you've been married for more than a year, but you're right. That's generally the rule, yeah. So you make those mistakes and it could result in years of savings being wiped out. You know, you don't need to take pictures, by the way, you know, because you get a copy of this. I'm a sharer, I like to share. Loss of tax deferred status, double taxation, excise tax, $8.5 million. How crazy is that, right? That's not fair. But here's the good news though. The IRS says in Secure Act 2.0 that certain mistakes they'll fix. But I've been talking to the IRS for the past few weeks and they're bouncing me around because everybody's saying, okay, Secure Act 2.0 says that we can fix some mistakes. We haven't even read it. There's no policy. So right now you're on your own. And this is one of those cases where prevention is better than cure and sometimes the only cure. Things to consider with rollovers. There are limitations on how often they can be done. There's tax reporting. CPA sometimes charges more if they get tax forms, right? $100 to do your return. I know it's more than that. But if they have to look at a 1099-R and a 5498, they'll charge you more. I'm skipping past these slides because I covered some of the content already. Client walks in to see you and say, Beth, I want to move my IRA to you. One of the first questions you say to them is, okay, I'm the best, you're at the right place. But are you the owner of the account or the beneficiary? Because the rules are different. There are some things that an owner can do, and there are some things that a beneficiary can't do, especially with employer plans. For instance, a beneficiary can't take a distribution and roll it over within 60 days. That's one of the #1 mistakes that I try to fix, right? And you can only fix those in most cases if the financial institution is at fault. So let's talk about when it's IRA owners and plan participants, because they have more flexibility when it comes to moving assets. Client comes in to see you and say, I want to move my Roth IRA to my Roth 401k. Who knows the answer to that question? Can we do it? You don't need to answer. You don't even need to remember that. All you need to do is pull out my cheat sheet, right? Can I move my Roth IRA to my Roth 401k? It sounds like you should be able to do it, right? But you can't. You can go the other direction, right? Roth 401k to Roth IRA, providing you're eligible to make a distribution. But here's a challenge for you guys. I get up at 2 o'clock, and believe it or not, I pick up the tax code and I leaf through it because I want to make sure I get everything. You get up at 2 o'clock and you look at the stock market, you look at creating financial plans, you look at a whole lot of other stuff. So you don't have time to remember all of this, right? Which is why cheat sheets like this are helpful. And the feedback that I get from clients is, you know, clients like when I pull out a cheat sheet and say, let me check to make sure that the information I'm providing you with is accurate. Because clients respect an advisor who's going to say, yeah, I'm one of the smartest and I'm one of the best. But the reason for that is that I don't trust memory. I trust understanding. And one of the ways I get understanding is to refer to my reference material. The 60-day deadline, one of the ways that individuals can lose tax-deferred status of an IRA. Now, there are certain things to remember about the 60-day deadline. If it falls on a weekend, client's out of luck. So they have to get it in on Friday. Although in several private letter rulings, the IRS have said, okay, I'm going to cut you some slack. But we know that private letter rulings are not authoritative, right? But this is one of those instances where they're a little bit lenient, but you don't want to have to go to the IRS because they're going to charge you $12,500. So this is one of those instances where prevention is better than cure. It's counted in calendar days. It does not apply to direct rollovers. Now, a direct rollover occurs when someone takes a distribution, say from an employer plan, and they say to the plan administrator, make it payable to my IRA custodian for the benefit of my IRA. Here's what I see, including from private letter rulings from the IRS. An individual misses they think it's a 60-day deadline for the direct rollover. So with the assistance of their attorney, they go to the IRS and ask for a private letter ruling. What's wrong with that picture? There's no 60-day deadline for a direct rollover. So they're wasting money. What should have happened in that case is they complete the direct rollover as long as the check is not stale dated. And if the check is stale dated, they have the issuer issue a replacement check. And for 60-day IRA to IRA rollover, you can only do those once every 12-month period. Now, if a client walks into your office and says, Beth, I'm going to pick on you again. Beth, I missed the 60-day deadline for my rollover. What am I supposed to do? Because I have this $10 million check, right? And one of the reasons why we do rollovers is to maintain tax-deferred status. And now it's 6 to 5 days. What am I going to do? And Beth's going to say, well, pump your brakes a second. Let's find out why you missed the 60-day deadline. Come to find out, this doesn't happen in your office, but some other advisor's office. The advisor's assistant took the check, had the client sign a contribution form, and forgot it and went on vacation. And when the client looked at the statement and says, where's my rollover? It was well past the 60 days. In that case, the 60-day period is extended to a year, right? So that's one of the first things you want to look for. Now, what if that's not the scenario? The IRS issued Revenue Procedure 2020-46, in which they said, listen, there are a lot of instances where we have been issuing private letter rulings for rollovers, and we're charging taxpayers a whole lot of money, but we're going to cut you some slack. If you qualify under one of these circumstances, then you qualify for an automatic waiver, but it's called a self-certification. And in Revenue Procedure 2020-46, there's a letter that they complete and give to the IRA custodian, and the IRA custodian codes it as a late rollover. Now, you got to be careful here because they're required to report late rollovers with a special code. And if the IRS detects that code, that might trigger them to say, let me look at this transaction. And if they determine that it doesn't qualify, then they're going to disqualify the rollover. So you got to make sure it meets all the requirements. Now, if they don't qualify for any of those two, then you can ask for a private letter ruling. But before you ask for a private letter ruling, because it costs $12,500 and the IRS is not required to approve it, you got to look at what were they doing with the funds. The case I talked about where the gentleman had the funds being invested, the IRS will say, you had no intention of completing the rollover because you had it tied up in some house. There's no way you could have completed the 60-day deadline. So you look at what were they doing with the funds. If it was sitting in an account that they thought was an IRA, for instance, then that's a very good chance that the IRS will waive it. Breaking the 1 per year IRA to IRA rollover rule. The IRS doesn't have the authority to make an exception in that case. So if you have a client who did 2 IRA to IRA rollovers, you can't go to the IRS for that. But I'm going to tell you what you could do if we're still within the 60-day deadline. Now, here's a challenge with this. All of an individual's traditional SEP, simple Roth IRAs are aggregated and treated as one for this purpose. So if your client comes to you and say, I want to do a rollover from IRA A to IRA B. I just want to use the funds on a temporary basis. Can I do that? You're going to ask him, have you done that in the past 12 months? Because if they have, they can't do it, right? Because you can only do that once during a 12-month period. But the loophole is, if they have already done one and they really need the funds, and it's a traditional SEP or simple IRA, we can do it, but the rollover has to be made to a Roth IRA, right? Still got to be done within 60 days, but in that case, it's technically a Roth conversion, so it's going to be included in income. Now, since they can't roll it over, it's going to be included in income anyway, but at least they get it in a Roth IRA where it goes tax-free, right? So encourage clients, use a trustee-to-trustee transfer method. Don't go to, if you're moving an account from, say, Schwab to Fidelity, don't go to Schwab and say, I want to do a transfer. Go to Fidelity and say, I have an account at Schwab, go get it. And then Fidelity is going to complete the transfer request with the assistance of the client, submits it through the transfer system, and have the assets transferred on a non-reportable basis, which is also non-taxable. Now, what do you do? And this is a real-life case. I had someone come to see me where his client was one of those investors, you buy property, you sell it, and this man did 14 60-day rollovers during 6 months. I mean, you can't make this stuff up. So the question now becomes, how do you fix something like that? Because some of them is going to be included in income, right? Any reporters in here? Because anything I say is off the record. So in a case like that, any rollovers beyond the first rollover is ineligible. And you got to fix that by return of excess, right? But that doesn't say that you cannot complete the other rollovers within 60 days. But because these were from traditional IRAs, those rollovers cannot be made to other traditional IRAs. So what could they do? Put them in a Roth, right? The other option, and luckily for this guy, he had a 401k account. He was self-employed. And so those rollovers could be made to the 401k account because rollovers that involve a 401k or other type of employer plan is not subject to the 1 per year limit, whether they're on the delivering side or the receiving side. Now, you remember that famous case, Bobro, right? We learned from Bobro that if you did a 60-day rollover from a traditional to a traditional, then all your IRAs are locked up. So you can't say, I'm going to do a 60-day rollover from Roth to Roth, because it applies on a per-person basis. And if you remember Bobro said to the tax court, but Publication 590 said I could do this. Why are you telling me I can't? And the tax court said, Publication 590, you rely on that at your own peril. That's not authoritative. I don't care if the IRS wrote it. Can you believe that? I mean, they eventually cut him some slack and started going forward. But the lesson here is, you know, if you call me, don't be afraid to say, Denise, I believe you, and you're charming and all with your Jamaican accent. But that doesn't work for my client, because I want my client to be able to sleep at night knowing that this rollover that they did or this transaction is accurate. And so I would provide you with a cite from the tax code or some other authoritative sources. Don't be afraid to ask for those if they make you feel comfortable. Rolling amounts that are ineligible. Every January, seriously, I get a call from an advisor that says, Denise, my client just rolled over their 401k, and now we get a letter from the plan administrator saying they should have taken an RMD and they didn't. That's an ineligible rollover. You get those calls, right? And sometimes the plan tries to get the money back from the custodian, but you can't do that, because once the assets hit the IRA, the custodian can't touch it without the permission of the IRA owner. So now we got to work with the IRA owner to do a return of excess by tax filing due date plus extension. Plan administrators are required to tell participants how much of a distribution is eligible to be rolled over, but sometimes they forget. Rollovers that break the 60-day deadline that doesn't qualify for a waiver, that's an ineligible rollover too. Rollovers that break the 1 per year IRA rollover rule, those are ineligible rollovers. So we want to avoid all of that. This should be 6 to 500. I know everyone's on top of that. So if you have a copy of the handout, and I'll correct it and give it to Kira so she sends that out to you. Ineligible rollovers create excess contributions. And in my experience, because everyone thinks the rollover is proper, they don't fix it. They don't know that's ineligible. And usually when I get the call, it's 5, 6, 10 years later. Now we have an issue with excess contributions. Now, here's some good news about the 6% excise tax. The statutes of limitation used to start with the client filing Form 5329. Who knew that? 2 people, 3, 4, okay. And so that's why that gentleman owed $8.5 million. He didn't know that. If he was working with one of you guys, he would have. And so on the Secure Act, they said, listen, we recognize that people don't even know what Form 5329 is. It's a stupid rule. We're going to change it. So now, as long as you file your tax return, it starts the statute of limitation. And now you have 6 years where the 6% excise tax accrue, but you got to be careful. Remember that abusive transaction notice that the IRS issued that says, listen, you're putting non-publicly traded assets in your IRAs at $10 a share, and next month it's worth $100 a share. That's abusive. That results in an excess contribution. This statute of limitation thing does not apply in those cases. So for your rollover transactions, I recommend creating checklists of questions that you ask your clients. Where's the money coming from? Have you done an IRA to IRA rollover in the past? And if for clients who do those non-publicly traded investments, make sure that they get a proper valuation, right? You know, I don't know how Peter Thiel did it. We saw with his Roth IRA, right? By the way, which is why I don't talk to reporters, because when you find a strategy that works well for your client and you talk to reporters and it's in certain newspapers, Congress just sits there and go, yeah, no more. You remember that Social Security thing that you start and stuff, right? You see how they're going after Roth IRAs. So it's nice to get your name in the Wall Street Journal, but try to keep it to things that are obvious, right? Those strategies that you learn, keep it just for your clients. And you can say to your clients, I know a strategy that can help you, but you don't want to tell the world, because then they're going to stop it. They're still trying to go after Roth IRAs. So here we have a case, and this is based on a real-life case, where someone took a distribution from a Roth IRA, rolled it over to another Roth IRA. And they did that on March 31st, 2023. Then they took a distribution from a traditional IRA shortly after and rolled it over. Is that rollover from the traditional IRA okay? No. Right? So no, they have an ineligible rollover, and they have to remove that as a return of excess, because if they don't, then you're going to have a 6% of $5,000 that accrues for every year. Rollovers to change plan types. I think everyone here knows about the age 55 exception. Am I right? Yeah, age 55 exception. That's only one of the exceptions that apply on a plan type basis. There are other things that you need to think about as you move assets from one type of employer plan to another. And here's an item for your checklist. When a client says, I want to roll over my 401k to my IRA, you got to ask them certain questions. How old are you? Because if they're age 55 and they qualify for the age 55 exception, then you don't want to move those assets to an IRA if they plan to take distributions before age 59 and a half. There are many tax court cases where the tax court have said, listen, you qualified for that exception at first, yes, but then you moved it to an IRA, and now you don't qualify anymore. How am I doing on time? Oh, good. So always check that. But sometimes the reverse is also true, right? Had a case with a client that had funds in a 401k account, wanted money for first-time home buyer purposes, and didn't want to be subject to the 10% early distribution penalty. That does not apply to a 401k, right? So to get the exception, we roll over the assets to the traditional IRA and then take the distribution from the traditional IRA. I see a question back here.
With regard to the age 55 rule out of employer claims, can you roll some of that money into an IRA and then use the 55 rule for the remaining balance?
That's actually a good strategy. Yeah. So in that case, you want to make it clear to the plan administrator that you want to do a split distribution and have them send the amount that you don't want to have subject to the 10% penalty to the participant. But bear in mind, though, that because that distribution is eligible to be rolled over, they're going to withhold 20% for federal taxes.
But you can do it as a transfer.
Right. You can do it as a transfer.
A partial.
A partial, right. But for the what she's saying is, let's say it's 100,000 and you need 20,000 right now, and you don't want to have the 10% penalty apply. Then you have that 20,000 paid to the participant, but they're going to withhold 20% for federal income taxes, and some withhold state taxes as well. So that's just something to bear in mind. If the client doesn't have extra cash outside, they may want to increase the distribution amount so that they get the exact amount that they need. Good question. Roth conversions is another type of rollover. The IRS said on their website that when someone takes a distribution from a traditional IRA and rolls it over to a Roth IRA within 60 days, that's supposed to be reported to them as a Roth conversion, right? But that's one of the #1 mistakes that IRA custodians make with Form 5498. Now, it gets to the Roth IRA within 60 days. That's a good thing. But now the IRS is probably saying to the individual, you owe me 10% penalty because this is not a Roth conversion. And so you want to make sure that when you have that client do an indirect Roth conversion, the custodian reports it as a Roth conversion on the tax return. Roth conversions are not subject to the 1 per year rollover rule. But here's what I see happening often. Clients request a Roth conversion, say of 100,000, and they'll say, withhold 20% for federal income taxes. So 80,000 hits the Roth IRA, right? The 20,000 that was paid to the IRS, that's not part of the conversion. So it's going to be subject to the 10% additional tax unless they're at least age 59 and a half or qualify for another exception. Let's talk about rollovers for beneficiaries. Beneficiaries cannot do 60-day rollovers. If someone inherits a traditional IRA and they want to move it, it has to be done as a direct trustee-to-trustee transfer. And I could tell you about many real-life cases where individuals, I had this case where this beneficiary did not want to deal with a financial advisor at all. And so they went to the new financial advisor and say, I want to move my inherited IRA to you. They went to the bank. You know, banks are a little bit dangerous when it comes to these transactions. So they require a lot of hand-holding, right? And don't be afraid to ask them 50 questions and have them repeat it when you're done and do a checklist. Because what I find is, like a lot of these frontline individuals, they get scored based on how many calls they can take within an hour. And you don't have time for that. You're dealing with quality, right? And so they'll yes you, no, yeah, sure, I agree, to get you off the phone to get on the next call while you're trying to get quality. So you keep them on the phone and you say, you make sure, I want this to be done as a direct rollover, right? Direct trustee-to-trustee transfer, right? And this is not going to be reported, right? For inherited IRAs, the case that I was telling you about before I interrupted myself, he went to the advisor and said, I just inherited, this was a significant amount of money, almost $1 million. He went to the financial advisor and said, I want to move this to you, but they're telling me it's going to take 2 weeks to do a transfer. And the advisor said, just go tell them to give you the check. The bank's across the street, right? So the advisor's telling me to do it, then it must be right. Went across the street, got the check, gave it to the advisor. Advisor puts it in the IRA as a rollover. IRS gets a 1099-R. In January, it says code 4. Code 4 means it's a distribution from an inherited account. IRS says, where's my money? You didn't include it in income. The client says, tax advisor says, I could do it. I don't owe you. IRS says, I don't care. You're not a spouse beneficiary. You can't do this. You should have done a transfer. So what the advisor should have done was to submit for the transfer. So be careful, because some of these mistakes can't be fixed. And one of those is where a beneficiary does a distribution when they intended to do a transfer. But Secure Act 2.0, again, is changing that. If the IRS, or when the IRS gets around to writing the procedures. Okay, which direction? Sorry. All right, I can talk in the meantime. So, if a beneficiary inherits an account, pressing the wrong button, we know from Secure Act that most beneficiaries are subject to the 10-year rule now, right? So if the beneficiary is subject to the 10-year rule or the life expectancy rule and ask for a distribution, then what you have happening is this man saying, I was told that I at least had 10 years. But because I followed this advisor, went across the street, got the check, now you're telling me the $1 million that I inherited is included in income in 1 year? Yeah, that's what I'm telling you. And that's because you didn't use the trustee transfer method. So we were already upset when Secure Act 1.0 took away the life expectancy option. It's going to be worse when if we don't give the client the right information, has cut that down to actually 1 year because they did a distribution as opposed to a rollover. So with inherited IRAs, you always want to do trustee-to-trustee transfers. With inherited 401k and employer plan type accounts, you always want to do direct rollovers. But another real life case had a scenario where a estate was the beneficiary of a 401k. And they worked with the IRA custodian. This was one of those friendly IRA custodian, and said, listen, daughter is the beneficiary of the estate. Why don't we move the assets to a 401k account, beneficiary account for the daughter? Because you know sometimes IRA custodians do that, right? Sometimes IRS issue private letter rulings saying that's okay to do. And so they move the assets to an inherited 401k for the daughter. No, I got a call like about a year later, because something wasn't right, as was detected by a new advisor who happened to be an Ed Slott advisor. And he said, Denise, does this look right to you? I know that a non-spouse beneficiary can do a rollover. Anyone want to tell me what's wrong with this picture? Beneficiary was an estate. In order to roll over assets from an inherited 401k, you have to be a designated beneficiary. So it has to be the designated beneficiary at the time of death, or the latest September 30th of the year following the year of death. Even though the financial institution moved it to an inherited IRA for the child was not the beneficiary at the time of death. The estate was. And whatever rules apply to the estate continue to apply even if the assets were moved to a beneficiary 401k for the child. So now again, they rolled it over to an IRA. That was not permitted, because that was not a designated beneficiary. And here we have an excess contribution. Here we have a case where distribution should have been made over the remaining life expectancy of the decedent, but then we had to include everything in income for 1 year. So, I mean, if any one of you guys want help with a checklist of some of the things that you need to check off as you have those conversations with your clients, feel free to call me, right? Just remind me that you're an Ed Slott Elite Advisor, and, you know, just don't make it too long or I'm going to start the clock running. But, you know, feel free to use my material and create your own checklist. right? Yes, sir.
I didn't mean to cut you off, but
Just-
along the lines of beneficiaries in the real world where there's remarriages and adult children and grandchildren, sometimes the grandchildren are even adults. It seems to me that it makes more sense if you're the elderly, the grandfather, grandmother, whoever, to almost separate your accounts. Like if you're remarried, hey, my spouse is going to inherit this account. And you break up your IRA, my adult child is going to inherit this account. That seems to solve for some mistakes.
Yes, because, if a mistake is made with one account, it could affect everyone depending on the extent of the mistake.
Especially if there's a new spouse. Like
Especially,
you got married at 60,
yeah, yeah. But of course it depends on the scenario. For employer plans, as you know, the spouse has to be the beneficiary. For IRAs, once the account owner dies, technically they become separate account anyway. So you want to make sure that the assets are segregated and moved to the individual beneficiaries.
They don't like to make things more complex, but it seems to solve some arguments.
It does. Had a case with a divorce where someone got one share more than they should get, and it wasn't pretty, So a daughter could say, you gave him one share more than me, or I wanted Microsoft and you gave me this, that. So yeah, separate accounts are usually a good thing to have. But the rule of thumb is that you can split everything down the middle or however ratio and give it to each person.
But the other problem inside of this is, because I had a client who wanted to do this, the other problem is, so you have 3 grandchildren, right? And you open up 3 different accounts. But now you have to make sure they're invested exactly the same and your RMDs are taken out exactly the same, because when the grandchildren inherit it, they have to inherit the exact same amount.
Or we're going to have problems.
Exactly.
Yeah. You're right. So it depends on the objective. But it could also be where, Johnny doesn't look for me, come and see me very often.
I want him to get more.
And I want him to get more. So I'm going to take the RMDs from the other account and leave Johnny's account in touch.
I once had this where I had to have a split between 2 beneficiaries. And what happened was they had bonds in the account, and when they split them, they couldn't sell the lots. They weren't sellable numbers.
Wow.
So they actually had to put them back together and liquidate them.
Yeah.
To put them back together.
So one item to add to your checklist, when you say to the client, you have 3 grandkids, split those accounts before death so that we avoid problems like that. So she's making your case.
Yeah, pros and cons, like anything.
Yeah. This is one of those beneficiary rollover cases. I like to use real life cases. This woman inherited 2 IRAs from her aunt, 2 different banks, went to 2 different banks and said, my husband and I discussed it, and I don't really need the funds. So I want to do a transfer to beneficiary IRAs at financial institution B. Now, she did say transfer, right? But she's talking to a bank rep that had been working for less than a year and probably didn't even understand the difference anyway. So because she told them she wanted the money, they had her sign distribution forms. And she rolled it over, and you know what happened. The IRS contacted her to say, not only do you owe me money, because it's not tax deferred, you have an ineligible rollover that you got to fix. Never go to the financial institution that have the assets if you want to move it from them. Go to the receiving financial institution and have them initiated and make sure it's done as transfers. One of the questions I get asked often is, can I convert an inherited account to a Roth IRA? Anybody think you can do that? Unless it's an inherited 401k, right? I see you smiling. I know you know that. So, with most things when it comes to retirement accounts, the answer starts with it depends. So when someone says, Denise, my client inherited a 401, my client wants to convert their inherited IRA to a Roth IRA, I got to ask them, what type of account is it, right? Because if it's a 401k, traditional 401k, they can do a direct rollover to an inherited Roth IRA. And technically, that's a conversion. But you're all right that you cannot, you're all correct that you cannot convert inherited IRAs to Roth IRAs. If you're a spouse beneficiary, you can treat it as your own and then convert it. Special rules for spouse beneficiaries. We know we got to be careful with spouse beneficiaries. They get a lot of benefits that are not available to other beneficiaries. How am I doing on time? I left my We could be here for 2 hours. So, you know, I want to give you some other secrets, some real life cases. So stop me if you have any questions, okay? I love the questions. Don't feel like you're overwhelming me, all right? Ask me anything you want. And trust me, the question that you think, oh, that's a stupid question, that's the one that's going to save your client. That's been my experience. Spouse beneficiaries. Always ask the question when a spouse says, I inherited an IRA from my spouse. What are my options? You want to ask them questions like, how old are you? Because if they're under age 59 and a half, you can keep the assets in an inherited IRA and then move it to their own IRA later on. What's the deadline for moving into their own IRA? Ah, you got this one wrong. Caught you. See, you guys are smart, but when you get up at 2 o'clock in the morning, you're looking at the stock market. You're not looking. Secure Act 1.0, the proposed RMD regulations that interpreted Secure Act 1.0 says, none of that stuff. We're putting a deadline on this. You can treat it as your own by the later of December 31st of the year following the year the participant died, or December 31st of the year in which the owner would have reached their RMD age. If I said that right. But here's the good news. If that deadline is passed, the spouse beneficiary can still move that inherited IRA to their own, except that it's going to be a rollover, right? Now, when they move it as a rollover, we got to make sure that the rollover does not include any RMDs, because RMDs can't be rolled over. So here is another trick that people have been talking about where the IRS caught wind of. You inherit an IRA from someone who died before the required beginning date. And as a spouse beneficiary, you're an eligible designated beneficiary, so you can choose a life expectancy rule or the 10-year rule, right? So you don't choose a life expectancy rule because you don't want to have to take RMDs. You choose the 10-year rule. And when it gets to the point where, 10-year rule is coming up and you got to start taking RMDs, you switch and move it to your own account. So you try to trick the system. And the proposed RMD regulation says, not so fast, right? That's a bait and switch. And before you roll it over, you got to figure out how much RMDs you should have taken had you chosen the life expectancy rule and make sure that's not included in the rollover. This is another real life cases. Use the real life cases to share with existing clients and potential clients, and tell them about people who think they're smarter than you and say to you, I don't need an advisor because I read an article online or I read publication 590, right? These cases are about these people. Like this lady inherited an IRA from her husband, and she read and she said, it's an inherited IRA. The 10% penalty does not apply. True, right? But she took a distribution she moved the assets to her own IRA, then she took a distribution. And when she filed her tax return, she didn't pay the 10% penalty. Now, the custodian, when they issued a 1099-R, they put a code 1 in box 7. And she challenged the IRS when they asked for the 10%, took them to court, and the tax court said, at one point you qualified, but the minute you moved it to your own account, you lost that exception. So we want to keep it in the beneficiary account until age 15 and a half for those who are going to need distributions. The 1 per year rollover rule applies to spouse beneficiaries, as was confirmed by the IRS in a private letter ruling. And again, you don't need to write that down. You get a copy of the handout. Yes, sir?
So she can have it as a beneficiary IRA under 59 and a half, and then move it to her own IRA after 59 and a half.
After 59 and a half, yes. But that's not the only point of consideration, right? Because a spouse beneficiary might say, I want to put off distributions as long as possible, or I want to minimize distribution. So if they have it in an inherited account from a owner that died before their RMD age, especially if they were younger than the spouse beneficiary, you can keep it in an inherited account until the decedent would have reached RMD age. Then you switch it to the spouse's own account. And at that time, instead of the single life expectancy table, the uniform lifetime table would apply, so the RMD is less. So there are a lot of different ways to look at it for a spouse beneficiary. Someone had a question over here?
Is there any time limit on that, or the time limit is you move it after the 59 and a half, and then you go back and you calculate thereafter?
You move it after age 59 and a half because then the 10% early distribution penalty no longer applies. But the time limit I talked about earlier applies to the treat as own option. But remember, when the deadline for the treat as own option has passed, we can still use the rollover options, right?
Depending on the time in the IRA, you can also split it, take part as the spouse's need, and take part as the beneficiary.
That's a strategy that can be used, yes. Because a spouse beneficiary is one that can do a rollover, right? But don't do rollovers for spouse beneficiaries into their own IRA, because then they can only roll over those assets into their own IRA if it's from a beneficiary distribution. If they're under age 59 and a half, you don't want to use a rollover method because then you're locked into being subject to the 10% penalty.
Denise, is there any reason after 59 and a half to leave it in the inherited IRA?
Yes. If the spouse beneficiary wants to minimize distributions and the decedent was younger than the spouse, for instance, then we know RMDs don't start until the decedent would have reached their RMD age.
So if they're 10 years separate, she's younger, he's younger, doesn't matter, then you would want to leave it in that way?
Yeah.
A couple of years?
Yeah, if the objective is to minimize distributions, right? That's one of the ways to do it. Because let's assume that she is 75 and she married a much younger man. He was 60. If she moves it to her own IRA, she's going to have to start taking distributions at age 75. But if she keeps it an inherited IRA, she doesn't have to start until he would have reached RMD age. So, you have a lot of spouses who have other assets and want to minimize distributions.
Any other ones besides that one?
That's the two, the 10% penalty and minimizing distributions.
Yeah, we've taken advantage in the last 5 years, 3 of them, and the banks and the mutual fund companies were telling them wrong, they were going to move it into hers, and I'm like, no.
Yeah.
We're going to need some of that money.
Yeah.
And we don't want to pay the extra tax, so that law has helped us out dramatically.
That's why you can't send them on their own to do stuff. You got to stay on the line with them, especially your, high value clients. Yes, sir?
Keep on saying about the handouts. How are we going to get those?
I gave them to Kira.
They're not on the site.
They're all going to be on the site.
Okay.
They're all going to be on the site. And the presentation.
I think they didn't want you looking at them while I was talking, but yeah. So, you meet with a client and the client already made a mistake. Can they be fixed, right? Sometimes. Here's a real life case that I'm working on, and I'm quite surprised that it can't be fixed. Client got a check from a 401k, a plan administrator. On the check, it says TRIRA, FBO Chase, right? JP Morgan Chase. What does TR stand for? Traditional, right? So custodians, they just don't want to do stuff anymore. They used to say, go get an acceptance letter and then I'll pay. Now they're just saying, here's the check, go. And so they gave him the check. He goes to Chase and he says to the Chase rep, here's my check for a whole lot of money that he worked saving so long. And the rep pulls up what's your social? Pulls up an account number, gives him the account number and says, here's your account number, put it on the back of the check and endorse it. Why are they making him endorse a check? It's made payable to Chase, right? He doesn't have any authority, banking rules anyway. So they put that check into his Roth IRA. The 1099-R from Fidelity says it's a direct rollover to a traditional IRA. It's non-taxable, code G in box 7, right? You can tell I'm mad because this upsets me so much. So we go to Chase, and Chase says, we're not fixing it because you endorsed the check. And I'm saying, but he shouldn't have endorsed it. You gave him the account number. You should have said open a traditional IRA. Bottom line is they're not fixing it. So now, because he's the good guy, he's including it in income and it's costing him a lot of money, right? He could have said, leave it in my Roth. The IRS will never know unless I get audited, right? Because Fidelity told him that it's tax-free. Put it in my Roth, 5 years, 59 and a half, tax-free, I'm home free. But he's an honest guy, and so he's going to include it in income. Man, I don't know what I would have done in that case. But the lesson here is, tell your clients, man, you know, if you want to go to a doctor or somebody to fix your fancy car, you get the right professional to do it. It's no different with your IRA and your 401k that you worked all your life to save your money. Work with an advisor so I'm going to throw you guys under the bus now. When someone comes to me and I find out that a mistake is made by an advisor, I call the advisor and I say, listen, you are an agent of this financial institution. I need a letter from you admitting your mistake. And then the custodian is more likely to fix it, right? Because you guys are honest and you're going to say, my mistake. And in that case, you know, if a client is moving an IRA over to you, I recommend doing an IRA audit. You don't want to be the one that accepted a transfer of that IRA that's subject to an $8.5 million excise tax. So it's good to do an IRA audit. So you ask clients, what have you done in the past? Especially do an audit even up to the previous year, right? So you can check for rollovers that broke the 1 per year rollover rule, rollovers that missed the 60-day deadline, etc. And usually if it's the financial institution that made the mistake, they're more likely to fix it. So here's some insider secrets. I had a client, financial advisor, that came to me and said, Denise, I had a conversation with this client. I made notes. He said, I have a $2 million IRA. I want to move $200,000 to my Roth IRA as a conversion. Yes, yes, yes. Everything was noted. When the client came in to do the conversion, the associate was there, had him sign a form for a $2 million Roth conversion. Right? So they get attorneys involved, and attorneys call the financial institution. The financial institution says, I'm not fixing it because he signed a form. And so they called me. And I called the financial institution. They said no, and I wrote them a nice letter, and they said yes. Had another case too where a beneficiary took a distribution advisor error and they fixed it. You just got to know how to explain it to them. You know, I know you guys are nice. I've had conversations with a lot of you. You know, the respect, being nice and stuff like that. In most cases, they'll fix it. I see a question over here.
What kind of documentation goes to the IRS when you're doing a Roth conversion? I've had some transfers from one company to another where basically we can say it's going from a traditional to a Roth, but then I had a company a couple of weeks ago that wouldn't document it like that. So what goes to the IRS when you're actually doing a Roth conversion?
Well,
you're doing between companies.
A 1099-R that shows the Roth conversion. In box 7, it's code 7 if they're at least age 59 and a half. If they're under age 59 and a half, it's code 2, and that tells the IRS that it's not subject to the 10% early distribution penalty. On the receiving side, a form 5498 showing that it's a conversion. So it's going to be reported, right? So it's got to be included in income, but the reporting is done showing it's a Roth conversion. Even though it says trustee to trustee transfer, it's not a right term. It just means that it goes from one financial institution to the other, but it's still reportable.
Okay, so one does the 1099 and the other one does the 54.
98, yes. I think I saw another question. Yes, sir. Yes. Everybody heard that? No. So let's say the client says, you know, I want to be like Peter Thiel, so I'm going to set up a self-directed IRA at a custodian and move assets from my IRA at Schwab to that custodian. He's saying, and I agree with him, the right thing to do is to go to that new custodian and say, go get my money from Schwab. And they're going to request a trustee-to-trustee transfer. That's not going to be reported. So no 1099-R, no 5498, no 60-day deadline, no 1 per year limit. That's how you want to do a transfer. Yes, I agree.
I'll assume that it was initiated at Schwab and they moved it over to the self-directed IRA. In that case, there's going to be a 1099-R.
Yes.
but it moved to another IRA. So is that going to have to be corrected in some way?
If the client completed a distribution request form, they're not going to fix it, even if they paid it to the other custodian. Because you could say, Schwab, here's my distribution form. I'm requesting an alternate payee. Have it paid to the other custodian. They're not going to fix the tax reporting. Now, if a client's in a hurry, what some financial institutions will do is like a paper transfer. So you go to the new custodian, you say, give me an acceptance letter confirming that you're going to put it in a traditional IRA as an unreportable transfer. You walk it over to Schwab and you beg them to bypass the usual transfer system. Here's your acceptance letter. Please process it as a trustee-to-trustee transfer. But they don't have to do it because they already have a system in place. But sometimes it works, especially if there's a matter of urgency and you get to the right person. Yes.
So code G is who initiates the transfer?
Code G is when you move from an employer plan, like a 401k, 403b, and you go directly to another plan, whether it's not a 401k, 403b, or IRA, right? So it's paid.
It's from the plan.
Yeah. With a code G, the plan is either on the delivering side or the receiving side, because you can also do direct rollovers from IRAs to a 401k, right? And code G tells the IRS that it goes directly into a retirement account. Not necessarily that it's non-taxable, because if it's a Roth conversion, then it would be taxable. Yes, sir.
I have a client who has an inherited IRA pre-secure, and this is a new client. She was taking out RMDs, in a stretch before. So I met her, and just recently though, she's been doing that for years. And then I realized that she said she stopped taking these RMDs back when the Secure Act started because her previous advisor said you don't have to do those anymore.
Oh.
So she's got a couple of years. Yeah. Is there any remediation for that?
Yes. So she was subject to the life expectancy rule. She stopped, which means she owes the IRS a 50% excise tax for every year it remains in the account. It's been reduced to 25% on the Secure Act, and if you correct it within a certain period, it goes to 10%. But in that case, you want to have her take those missed RMDs or put a procedure in place to take it, and have the CPA file Form 5329 and ask for a waiver, because that's definitely a reasonable error, bad advice from the advisor. And the IRS, 99.9% of the time, will waive.
2 years.
2 years, okay, so that makes it easy. Now have her CPA do it. Don't have him call me, because I charge for that. But have them file Form 5329. Now Form 5329 is tricky. If you don't do it right, the IRS will say, where's my penalty? Because the instructions are real murky. But you want to make sure that at the end, it says no excise taxes owed.
You need to do the 53-29 yourself, because when you kick it over to the CPA, they're going to make you pay the penalty first, and you never get it back.
Yeah, but
Ed Slott way,
yeah.
they'll tell you how to do it.
Yeah, in that case, you say, no, that was 2015. As of 2015, you don't pay the penalty anymore. Okay. Okay. I've had 19 years. I got you beat. 19 years. IRS said yes when we filed, though. See, look at us all sharing stuff. You can stand up and let people see you that you're the 5329 expert. Yeah, over here. Any more questions? Come on, more questions. Yes.
Okay. 84-year-old mother passes away. I think it was September of 22. Daughter is the heir, multiple accounts. We do the transfer paperwork, and then the custodians take too long, and it's not until January of 23 that the transfers happen, so we didn't get to do the RMDs. In other words, they didn't get forced out last year, and the custodians didn't force them out on the way over. And it happened, so it was for 2022 RMD that got missed.
Okay, good news. Yeah, good news. Under the proposed RMD regulations for Secure Act 1.0, the deadline is tax filing due date plus extension of the beneficiary. That's an automatic waiver. So as long as the beneficiary fixes it by, she died in 2022? As long as the beneficiary fixes it by tax filing due date plus extension for 2022, we're golden.
Okay, good, because that's not what her CPA said, so, but I like what I heard.
More questions? Should we send him away? He had a question? One last question?
All right. Any recourse where 401k participant with 8-figure NUA screwed up and took RMDs that violated post 65, post 70 and a half, that violated her ability to do NUA until death?
Remember that where I said earlier, sometimes you want to cite to say to the client that this is fine or this is not fine?
Yeah.
Send me an email and I'll send you a site that says that's not an issue.
Really?
Yeah.
Great.
But I'm talking about RMDs, okay? Just so we're clear, not any other type of distribution. I see Ryan over there wanting to kick me out.
Yes.
Create checklists, cheat sheets, all that stuff. Feel free to use my material, okay? You know, all of this is on the handout that you're going to get. We have already looked at that slide. So I want to thank you guys for your attention and your time. You were great.
Denise, that was great.
Thanks, everybody, for coming out to this breakout. As Denise said, the handout and the presentation, as well as for Marty James, because you guys weren't in that session, all of that, along with the audio sessions, those will all be posted on the site this coming week, so you'll have access to all of that stuff to review. So go get some ice cream, and we have our extended break to meet the sponsors.